Hello, everyone. Welcome back to another CMC Masterclass session. So many U.S. stocks pulled back from their multi-week highs as tech shares fell ahead of the FOMC meeting and the major earnings reports this week that we're continuing to see. So let's get some insight and analysis from one of the regular contributors at CMC, Mish Schneider, the Director of Trading Education and Research at MarketGauge. Mish, I say this to you every week. It's nice to see you again.
Great to see you too, Ricardo.
So, Mish, for the last 2 weeks, we've been looking at updates in the commodity markets, and we saw some general solid movements in the gold and other metals. But I want to shift our attention this week to the stock market, particularly around earnings season, which continues to weigh in the performance of, as we see, the major U.S. equity indices. So we're looking at tech heavyweights, Amazon, Apple, and Alphabet, particularly, which constitute about 1/3 of the Nasdaq. It's always full of surprises, that one. And I think just looking at the general consensus of the market, many have warned that the earnings might not live up to expectations and the markets could sell off. But this begs the question is, how should day and swing traders look to trade earnings season? And I'd be keen to also get your take on the current markets.
Well, great. Thank you. Well, first of all, in terms of the earnings season, it's been a bit of a tale of two cities, to quote a very famous British author. And that's because some of them have been really dismal and with very poor guidance going forward, where others have had surprises. And I know we're going to talk about Apple, Spotify being one of those surprises. And so that means that you really do have a bit of a crapshoot when you're going to trade into an earnings report. We're not number crunchers. We're not going to sit here and analyze EPS and revs and all of that. What we're really going to be looking at is obviously the overall sentiment of the market. We have FOMC that could either make or break the markets, obviously this week in the US, and of course the technicals. So right now, this is such an interesting spot technically in the market if we just look at the S&P, because we have had a trading range, and it's something actually I've talked with you and your viewers about this year, or even coming into this year, was that we were expecting this sort of trading range. So right now we've retreated, as you can see on the chart here, from the high. We have not passed the December high, which is something interesting to note. And we do have a moving average here in the 50 while we have a declining 200, but we haven't had that classic, what they call golden cross. And the momentum, if you look down here, is moving up. We did have a golden cross in momentum way back here when we made this high, but we have actually had a mean reversion. So basically what this is telling me right here is that if we can get through these December highs in the SPY, it's one of those things where you sort of close your eyes and just follow the technicals, obviously have a risk in mind, anticipating what I think is the ultimate top of the trading range this year, which is 4,200 in the SPY. Conversely, if the Fed pulls a surprise and goes 50 basis points and creates a lot of selling, then we would be looking at the potential of what happens near the lower end of the trading range, at least the one that we have seen also as a December low, versus what could happen if things continue to deteriorate. And we'll talk about that later, what could really ruin this market more than the Fed. And then I would think we would look at more like a 3,200. So we're smack in the middle right here. And that makes sense fundamentally and technically.
Right. And what's interesting as well, before we kind of dig deep into the examples that you gave about Spotify and Apple, I think for a few stocks, let's look at Microsoft as an example. When they reported announcement earnings, we saw that stock rally, and then once they gave guidance post that, that's obviously reversed. So is there anything that you can probably highlight to when these earnings announcements come across? What should a trader really focus on, and how should he approach such a key event in the market?
Great questions, because that is really something very interesting about earnings. However, I did mention it in my outlook, my 2023 outlook. This is a company called Tetra Tech, and they're a software company, but they're also working on alternatives to using lithium for EV batteries. So it's basically software in some sense, but also related to commodities in EVs. And we have a position, and we're long from down here. So the reason why I'm telling you this is because A, we've already taken a profit, and B, is that if we decide to hold into earning, it's because we believe we have enough of a cushion to safeguard us against any major surprise, like this thing winds up opening up 20% lower because the guidance or because the EPS were well under expectation. And that's my tip, is that if you already have something and you have a deep cushion, makes sense to take a profit ahead of earnings. We have such a small position in this now. I'll make that decision either at the end of the day or first thing tomorrow morning, but when it actually reports. But nonetheless, that's what we would do. Would I buy this stock or any stock the day of earnings? Options traders can do that if they really understand how to put on good protection with spreads, or some of the more fancier ways that option traders can actually play, because what they're looking at is playing the volatility of a potential stock after it reports. So in some cases like Tesla, they got a payoff because the volatility increased. In others, they don't get a payoff. And Microsoft would have been one of those where they didn't get a payoff. So again, it's always a gamble. And that, I think, is something to figure out. That's why we kind of advocate, if you're not already in it, you don't already have locked in profits, wait till the post reaction. And that's what we're going to talk about now.
Perfect. So let's start digging into Apple. Just kind of a quick background. Doesn't seem that the market expects for it to have a stellar fourth quarter. Analysts are forecasting earnings to fall about 7.7% year on year. But from a technicals, and this is what we're going to focus on today, and stock appears a bit overextended as the RSI is approaching about 70. What can you tell us from the charts, and what's the technical play here?
Okay, well, before I show Apple, we had one little surprise today. And of course, streaming services did well. Netflix was a classic example. It actually did a lot better after it reported. And so Netflix went up and hit resistance, obviously, like everything has right now. But today's surprise related more to Apple and in the streaming part, because Apple has Apple Music, is what Spotify did. And that's what I wanted to show you. So you have a day like today where if you weren't already, let's say, long this stock because it cleared all this resistance back here, back in early January, where you might have had a decent risk against the 50-day moving average. See, today you would have had the payoff, you would have stayed with it. This is what I'm talking about. But let's say you're looking at this for the very, very first time, you have a gap up. And this is why I want you to be prepared for Apple. If we got some kind of gap up based on A, its streaming services doing better, B, it's actually sponsoring the halftime show of the Super Bowl. I know that that's not the biggest thing in Britain, but it's a big thing here in the United States. And the halftime show is Rihanna, probably one of the biggest stars in the world. And so if that gives it a boost and we get a gap up, then you can either employ a 30-minute opening range rule, a 2-minute opening range rule, in that the bigger the gap, the shorter the time frame that you wait in order to enter that particular position. And so I don't have this particular chart. Let me see if I can actually, yes, we can do this. If we looked at this as a 30-minute chart today, you can see that your 30-minute might have been waiting too long because it was such a big gap. If we look at this as a 2-minute chart, and I just think this is really important here, we go to this day, it didn't have a 2-minute opening range breakout. Look at that. So this showed you that it may have already exhausted its impact to the upside, and now it's finally breaking out now. But would I necessarily trust that breakout? I would probably say, let me see where it ends at the end of the day. And the reason why I'm showing you this is because this gap buy post earnings surprise is sometimes a very profitable way to do things. Now, if we go back to a daily chart, and it's good to show an example of something has happened. If we get some digestion, which would be not surprising ahead of a FOMC meeting, then you can say, wow, if it breaks out of that range that it established today, for example, we have a very simple risk underneath the gap low. So it's with that I want to show you Apple, because this is really giving you the benefit of all my experience. So now if we take a look at Apple, and we scrunch this up a little bit, this also has been a very range-bound type of trade. You can see that we had obviously the nice bottoming formation as we began January. And so we're in a very interesting situation. So that tells me if Apple reports better than expected, and it clears, let's call it 150 for a nice round number, you can apply the gap rules I just showed you with Spotify, which basically wait a couple of minutes. If it breaks out of a 2-minute range, you could buy it, put a stop right under the low or a little bit of fudge, and see if you can get some traction out of it. And if it closes in your favor, great. If not, obviously it's a day trade, you're gone. On the flip side, if it doesn't have a 2-minute OR, like we just mentioned here with Spotify, well, this would have a better chance of follow through one way or another because we'll be done with the FOMC meeting. If it doesn't, then you may want to wait for some kind of a consolidation and have a second day look or third day look before you got in. On the other side, though, because this has had, by the way, leadership in that it's been outperforming the SPY, and in momentum, we've actually gotten over, there's a divergence. Notice this has been over the 200-day moving average in our momentum indicator. And those of you who read my reports that I've been doing for CMC for a long time now know that I feature this momentum indicator a lot. It's divergence because it hasn't cleared in price. So even if it's a big non-event for Apple, with this divergence, I would wait for 2 closes over the 200. And that would give me a signal maybe that now the phase is good and we can go long. On the same token, if this turns out to be a false reading and we start to see the momentum decline and our earnings are not that great and we break down, let's say under around 138, then I might be looking at something like this, which is actually the short Apple. It's not a leveraged short. It actually something to keep in your mind and write down is this AAPD. If Apple reports poorly, if the Fed kills the market or what have you, once this gets back over that 50-day moving average, that might be an interesting play as well to get short with still buying something.
Right. And I saw a bit earlier, I was kind of looking at that resistance zone. And if you say if Apple does retest the resistance zone from about 139, 140, does it make sense for a textbook support resistance flip almost at that stage?
Yeah. I'm sorry, let me go back to this Apple chart so you can see it. If it breaks down under that 138.40, yeah, I mean, I would think that that would send a message to the market that regardless of the strength in streaming, regardless of all the good news, that if, especially with this being post-Fed, if the Fed is going to continue to fight the face of inflation by being more aggressive and more hawkish, then it may not fare well for Apple. There's also obviously a China influence there because we're still having a trade war with China, particularly with chips. And certainly the iPhones would be impacted by that. There's going to be a lot to unpack from the Apple earnings. But it's going to kind of like, I think, be the Tesla of last week because Tesla really, I think, single-handedly dragged this market back up, just as Apple can bring it to a new level and can also kill the rally in a heartbeat.
Right. Well, so moving a little bit into Amazon, that's the second stock I'm really quite interested in. It's from a technical perspective, that stock appears to be approaching overbought levels as well. Resistance possibly around 103. So what are you watching again ahead of that earning? And is there any indication that you're paying close attention to in Amazon's chart?
Well, Amazon, of course, different than Apple, although consumer driven, is definitely going to reflect this consumer staple area in a sense. Jeff Bezos has not talked very fondly about the stock or the economy for that matter. And we just had consumer confidence come out weaker in the US. So this will actually be maybe in some ways more related to not only the sentiment of consumers and buying cheaper goods, even cheaper goods now starting to wane because they're only buying the absolute essentials, versus people feel more confident about the US economy and are coming back in regardless of the backward-looking consumer sentiment. Now forward-looking, more possible that we're going to see a soft landing. I mean, this is the things that people are watching. From a technical standpoint, by the way, this too has been outperforming the SPY. And you can see, again, no golden cross. divergence is stronger even here than in Apple, in that the momentum indicator is above the 50 and the 200. The price is above the 50, but look how far it is from the 200. So I would say for Amazon, the first thing I would look at is, even if it gaps up above all these levels, and you could see the big gap down it had in the last earnings report, even if it sees a gap up above these levels, you want it to be a strong enough gap to fill this gap, which means you want to see this get up over 109.77. If you look at the top of the screen, it shows you the high low of this particular day that my cursor's on. So when things fill gaps, I think that's very, very strong. So if it filled the gap and then was able to gather some steam and clear the 200, then it would be in line with what the divergence of the momentum is showing you, is that this has a lot of upside potential. If it doesn't fill the gap, or if the earnings are poor and it starts to fail, even let's say the 100 level or the 99, 100 level, you don't even have to wait that long. Then what you might, this great momentum actually may turn out to be more of a mean reversion, which means these little dots break down under the Bollinger Band. And the fact that the 50 is under the 200 and the 50 is under the 200 sends this back more into a bearish market. So again, crapshoot. In this one, I'd say even more than the Apple, because the consumer has been such a question mark, and because of inflation, even though people think it has peaked, clearly has not, and it will start affecting the consumer again.
Right. So going into Alphabet, I think that stock was particularly attractive to me because that was possibly the only stock that has positive consensus from Wall Street, potentially looking at strong revenue and earnings growth potential. But again, looking at a technical outlook, bearish, bullish, what's your take?
Well, the other thing you have to remember about Google is they seem to get in trouble with the government all the time. Nothing really happens, but it makes a headline every once in a while, and it just made a headline again. So in fact, the big news here was not only was Google back under investigation for antitrust, but also Nancy Pelosi sold all her Google shares for a loss. Which people seem to be very happy about. Anyway, just a little fun. But in terms of looking at the stock, again, Google, AI, obviously there are new companies that are coming into the AI focus with ChatGPT, very much a big part of things now with Microsoft, and yet Microsoft hasn't really moved very much yet. And you can see, again, we talk about a trading range. So let's go back to that December high. That is looming large here at 102.25, which is still another $5 up from here. So if Google surprises to the upside and takes out that December high, you would run into a little bit of resistance here again at the 200. But again, look at what's incredible is all the momentum here is suggesting that the price is undervalued compared to the actual momentum. So it could be a potential buy again, if the momentum is telling us that the price has to confirm. And if it can't confirm, then we could see a big giant mean reversion once again. And at that point, we would take a look at what happens here at the 50-day moving average or around 93. So I would say wide range, but really we're looking at a range between 93 right now, and let's call it 103, just to round off. And in between would be chop zone. So I would be, definitely interested to see what that range breaks after earnings.
Right. So I guess these three stocks, as we said at the beginning, they have a lot of weightings on the S&P, particularly NASDAQ, but also the S&P. So the S&P earnings have improved slightly after just 143 reports. I think there are more now, but can you talk us through what you're seeing on the charts for the SPY? I know you mentioned that at the beginning, but assuming, there's a lot of scenarios that can happen here, but assuming a hawkish Fed and what you just spoke about the earnings, what could we expect from the SPY and what are the next level that you're looking at? And then we can move on to the NASDAQ.
Okay, so the high of this December high was 296. So let's call it 297. On this particular day, we got up to 298. We cleared it, but we did not close above it. So that tells me that if we can get over, let's say, this 298, or again, this December high, it's very possible based on all the bottoms that we have here in NASDAQ and this sort of just mini formation that we've had here, which some people can say is kind of a quasi inverted head and shoulders, then, just looking at the measured move of there from 260 up to 300, let's just round up $40. There's no reason why we can't see a move up to around 350, 340, which would put us back to where we were in April before we saw that big dump here. And again, that's, I mostly watch the SPY for the trading range, but it's certainly interesting, even when I'm discovering this as I'm talking to you, that would be, that would be a really nice rally, obviously. But it would certainly, again, I don't think would clear much higher over the 340, 350 level. I just don't see it. And then, of course, if we look at the other way, if this is telling you that we just rallied to this December high, couldn't close above it, and that's it, then this week, certainly with these big earnings within the NASDAQ basket, we get back down under, let's say, 290, 288. We'll hit 280, which has been an extremely important pivotal level. As you can see here when it rallied, here when it broke, here when it rallied, had one little fake out right here. And if we get down under that level, that 280 level, then I see no reason why we can't go back down and test these lows one more time. And, maybe I would say, instead of going all the way down, depending on what SPY does, the low of this move has been 254. So 260 to 250 would be where I would start thinking that maybe it would get oversold.
Right. This has been really helpful. Before this call, you and I just had a quick conversation about how you'd like to look at inflation. You pointed out some really interesting points there. If you don't mind just going through them again, I think that'd be helpful for the audience.
Well, I don't think that people should look away from commodities right now. And I'm not talking about the classic ones right now. Obviously gold and silver are still doing very, very well. They haven't really budged. They've just been consolidating, and that should tell you something. But I mean, look at what's going on here in this market. If you just look at sugar right now, sugar is actually higher than this. Sugar just traded up here today. This is an end of day contract that only updates at the end of the day. If you look at coffee, this thing is now all the way up here, coffee, right? It's trading at around 175. So it's taking out all this work. If you look at lumber, and remember, these are all only updated as of the close of yesterday. But if you look at lumber, look at that thing has been flying high. And I can say the same thing even if we look at wheat. It's starting to show signs of bottoming. Corn starting to show signs of bottoming. Soybeans already very, very high priced. Orange juice futures, those of you who ever saw the movie Trading Places, also now starting to move up higher. Cocoa starting to move up higher. So we've had inflation numbers come out of Australia, Spain, Italy, Japan, showing incredible rise in inflation. Japan 41-year high. And the United States is sitting around going, inflation's over. And I don't think it is. I mean, not to mention all the geopolitical situations that we have with possible spark plugs all around. So I would say the commodities and the equities markets classically can go up together to a point. But if we don't see some of these soft commodities, the things that people actually eat and need, go down and they continue to accelerate, I would not be surprised to see whatever fun rally you're having end very abruptly and quickly. And most likely it would start with our next round of PCE numbers and CPI and PPI numbers going up instead of down, because all they've done, as far as I can see, is corrected from the highs, but not necessarily shown that inflation is over.
Right, Mish. It's been a pleasure as always to speak with you, and thank you for your insights. As always, we'll speak to you next week as well.
Okay.
Thanks for your time.
Thank you so much, Ricardo.